Very good morning, friends. I hope you're all doing well. And of course, as I always say, most importantly, that your cumulative revision on the standard is going on. So technically, of course, if you look at the signage, we are supposed to start with Ind AS 110. But of course, I'm left with a little portion on Ind AS 103. So we need to discuss, first of all, the concept of reverse acquisition. And then I need to discuss with you the concept of common control accounting. Because if you remember, when we started the journey on Ind AS 103, we identified a total of 3 kinds of accounting which Ind AS 103 addresses. We have already covered the details as far as acquisition accounting is concerned, wherein I gave you a 7-step model, and I hope you've tried the questions which I gave you last time. 2-3 very pertinent questions. One dealing with the huge level of deferred tax. One is with the inputs in terms of the step number 3B, where you start looking at the exceptions. And of course, there are a couple of questions in the study material. If you look at quite a good coverage, those questions were there in the study material as well. Now, we come to the last phase of Ind AS 103, and one of the very tricky kind of issues which generally, students find it quite difficult and complex, but we're going to make it very simple. So one is the case of reverse acquisition, and the other one is the common control transaction, which is not very complex as compared to the reverse acquisition, but sometimes, yes, it can get a bit tricky. So we're going to understand the nuances, in relation to both of them, because reverse acquisition is being addressed specifically in the Appendix B to the Ind AS, and the common control transactions is being addressed in Appendix C of the standard. So let's begin the journey, and let's first of all start with the case of reverse acquisition. Though if you remember, when we started off with the acquisition accounting as well, I gave you a flavor of a reverse acquisition, and I gave you that how does it indicate that it is a reverse acquisition. And if you distinctly remember, there were typically, you can say, 2 cases where a reverse acquisition could happen. Just to remind you, when I made a chart of identifying the accounting acquirer, I gave you a total of 4 permutation combinations. I think, let me just quickly take a recap before we take you to the acquisition accounting. So in this particular case, what I can say, if you remember, there were a total of 4 permutation combinations which I gave you. And the first combination which I said that if your purchase consideration is primarily in cash, or the purchase consideration is primarily in equity shares. I mean, this is the same chart which I'm reminding you when we identified the accounting acquirer, that your purchase consideration is primarily in terms of cash or shares. And then we said there are 2 permutation combinations, that whether a new entity is being created or a new entity is not created. So let's say the new entity is not created or it is created. Now, in this particular case, if you remember, in terms of acquisition accounting, I had very clearly said that if the consideration is primarily in cash, it doesn't make a difference whether a new entity is created or not. Generally, this would never be a case of reverse acquisition. It would always happen to be a case of acquisition accounting. Because the consideration, whosoever pays the consideration becomes, you can say, the legal and the accounting acquirer both. So if the consideration is in the form of, you can say, primarily cash, the standard makes it very clear that it would be a case of acquisition accounting. So what we need to see is these 2 cases, when the consideration is primarily paid in equity shares and a new entity is not created or a new entity is created. And if you recall it very well, then I said if a new entity is created, generally it can never be an accounting acquirer. In this particular case, we said even the standard makes it very clear that one of the existing companies would be the accounting acquirer. So 99.99% to be on a very safe side, this would definitely be a case of a reverse acquisition. And if a new entity is not created, then I said it depends. It may or may not be a case of reverse acquisition. And in this particular case, you'll have to typically calculate the percentages post business combination and take a decision whether the control of the acquirer is lost. The legal acquirer, loses a control post business combination or not. So it may be or it may not be a reverse acquisition. So it may be or it may not be a reverse acquisition, or depends upon the post business combination percentages. Which means one thing is very crystal in the mind, that to be a reverse acquisition, what is important is the purchase consideration is primarily going to be in equity shares. That's one major focus point. I'd like to emphasize this once again out here. So we're looking at that for a reverse acquisition, what is important is that the consideration is going to be primarily in terms of equity shares. That's one focus point. And the second is that if you're creating a new entity, then certainly it is a reverse acquisition. So there is a question in the study material as well, which gives you an illustration where a new entity is being created, and the consideration in that case, I would say not primarily, but 100% is in equity shares. So it is undoubtedly a case of reverse acquisition. So we're going to do that question with you. Secondly, there is another question in the study material where the consideration is primarily in equity shares. A new entity is not being created. And I would say in that case, again, the consideration is 100% in shares. And when we look at the percentages, the legal acquirer loses a control post-business combination. So I think to understand the nitty-gritties on a reverse acquisition, we're going to do both the illustrations with you. One, where a new entity is not created. Second, when a new entity is created. And let me tell you that when you look at the case of a reverse acquisition, everything is common. When you look at the 7 steps, leave the 7th step, which is an entry, which I'm not going to show in a reverse acquisition. So if you look at those 6 steps which we did, trust me, we're going to do the same 6 steps itself. So even in terms of reverse acquisition, the steps would remain the same what we covered in acquisition accounting. The only thing is that there is a little more technicality involved in terms of the step number 4, when you calculate a purchase consideration. So that's where we need to get a little expertise. So no worries, we'll make you experts on that area as well, that when amount of PC, a purchase consideration is computed, and what kind of technicality gets involved in a reverse acquisition. So let's begin the journey on a reverse acquisition. Okay, so meantime, let's see if there is any questions coming in as well. Otherwise, we'll start the journey. Oh yes, I'm getting some questions. Good morning to all of you. I think Prashant has got a question. Good morning, sir. Please provide all accounting entries chart related to pre-business combination, date of acquisition, and post-business combination. I did that, friend, in the previous class itself. If you watched the previous section, in the previous class, I gave a combination of all the entries, pre-acquisition date and the post of acquisition. And then he said, and how all such entries get eliminated in the consolidated financials of the acquirer. Please provide a master chart of all the accounting entries with respect to acquirers, SFS and CFS. Well, I guess I've not given entries on the SFS because we're yet to cover Ind AS 27. But trust me, in the previous class, you can watch that. It's on the YouTube, which I took on Sunday. I have already given the entries on a pre-acquisition date and everything. Well, sometimes I feel the time is a little limited. Otherwise, I would have given a lot more value addition as well. But still, we're going to take the best of the time. So in any case, you can refer the previous class. You'll get all what you want, friends. Definitely. Okay. So with this inputs now, let's get on to the question on reverse acquisition. This is a question which is given in the study material as well. And it's also given in the education material issued by the Institute of Chartered Accountants of India. And it's come in one of the mock test papers as well. A very interesting question indeed. Let's read the question with you. So I am given the inputs in this case that on 30th September X1, entity A issues 2.5 shares for each ordinary share of B. So the exchange ratio which is given is 2.5:1. So the company is issuing 2.5 shares for every one share. If you remember the very first class which I did, in that particular case also, trust me, I took the same example intentionally to give you a flair of the reverse acquisition. Then it says all of entities B shareholders, all the entity B shareholders exchange their shares in B, which means there is no NCI. Fortunately, unfortunately, you see the questions on reverse acquisition, there is no NCI, but that doesn't mean that there cannot be an NCI in a reverse acquisition. But the two questions which I'm going to do, there is no NCI in the questions. Therefore, entity A issues 150 shares in exchange for all the 60 shares of B. So B has got 60 shares, and when you issue 2.5 shares for every one shares, you land up issuing a total of 150 shares. So that is the input given. The fair value of each ordinary share of B on 30th September is 40, and the quoted market price of A's ordinary share is 16. So we're given the fair value of B as well as A. Well, we can definitely see that the legal acquirer is A, because A is issuing the shares to the shareholders of B, but it needs to be seen whether he is an accounting acquirer or not. The fair value of entities A identifiable assets and liabilities are same as the carrying amount, except the fair value of the NCA is 1500. This is also, trust me, one of the indications. Now, what I'm about to say is not a conclusive evidence that it is a reverse acquisition, mind you, but I'm just trying to give you certain areas of hints. The examiner would give you a little hint in terms of the fact that it's a reverse acquisition, and two hints have been indirectly given. See, one is, I would say, a more direct hint. When the question says that A issues 2.5 shares for every one share, it indicates that there is a possibility of a reverse acquisition. If you land up issuing too many shares against one share, you are basically telling the other person, I'll give you a huge number of shares in my company. So for every one share, if you land up giving them 2.5 shares, the number of shares issued is too much. So I am just saying that a two-query, then he would have given you the net assets of B. Because when you're looking at an acquisition accounting, we always create a list of net assets for the acquiring company. So the moment the question is giving you information that the net assets of A, which is a legal acquirer, is given, that's again a very direct hint that it is a case of reverse acquisition. Because if A becomes an acquiree from an accounting point of view, then you need the net assets of that company at a fair value. So these were, one is an indirect hint and one is a direct hint. And of course, a very, very direct hint is already given in the balance sheet as well. The statement of financial position of A and B immediately before the business combination is given, and it very clearly says that A is a legal acquirer but an accounting acquiree. B is a legal acquiree but he is an accounting acquirer. So the balance sheet is given. And further, we are also given that entities B earnings for the annual period is given, and the consolidated earnings are given, and assume that there is no change in the number of ordinary shares, but that's all for the EPS calculation. But this part is not really addressed in the study mat, so I'll not get into the calculations of EPS in this case. And as it is, you need a little exposure on the concept of Index 33 in order to calculate that. So I'm not going to focus on the earning per share. And let's have a look at what is the requirement of the question. And the requirement of the question is pretty clear. It tells us that we need to calculate the fair value of the consideration transferred, measure the goodwill, and prepare a consolidated balance sheet on 30th September. So the focus is in terms of calculating a PC, the focus is in terms of calculating a goodwill and also preparing a consolidated balance sheet as well. So we're going to address all the issues in this case. Let's begin the journey. So at the first instance, let me do one thing. I am first of all going to go on a step-by-step basis with you. So we'll begin our journey in terms of the same 6 steps which I gave you. So let's begin. So I am starting with the step number 1. So in terms of the step number 1, I said you need to identify the accounting acquirer. At the first stage, what do you need to do? You need to identify the accounting acquirer. And since we can notice in this particular question that in this particular case, okay, Namrata, you said, so please take questions on NCI as well. Okay. Well, I could not see any question on a reverse acquisition within NCI. I searched it quite a bit, and the question which we're doing is actually also one of the questions released by the International Accounting Standard Board. So unfortunately, I couldn't even get a hold of a question where there is a presence of an NCI. So no worry. Okay, so on the step number 1, we are going to first of all look at the accounting acquirer. So we need to get the percentages very carefully. So look at the balance sheet of the given in the question. This is a question which is given in the study material as well. So if you've got your study material, just open the test your knowledge section and you're going to see the question number 2 in the test your knowledge question. So this is the question number 2 in the study material as well. And that is a part of test your knowledge. So we open the T by K question number 2, you're going to see that question. Now in the balance sheet, which is given in the question, A is got a total of 100 shares and B is got a total of 60 shares that is given in the balance sheet of the company. Now, A told B shareholders that I will give you 2.5 shares for every 1 share. So that's already given in the question that we landed up issuing 150 shares to the shareholders of B. So let's calculate the percentage on a post-business combination. So if I calculate the percentage post-business combination for the shareholders of company A, we can see that company A shareholders have got 100 shares in the company and the shareholders of B has been issued another 150 shares. Therefore, the total capital of A post-business combination becomes a total of 250 shares. So in this particular case, we consider 100 by 250, so that comes to 40%. So we can very clearly see in this case that once A issues the shares to the shareholders of B, the control of company A dilutes from 100% to 40%. The shareholders of A were having all the shares in company A, but when they issued the shares to the shareholders of B, their percentage dilutes to 40%, which means they lost a control. So which indirectly implies that the control passes on to the shareholders of B. They've got a 60% stake in the company. So if the control passes on to B, it is undoubtedly clear that it is a case of reverse acquisition. And the moment we say it's a reverse acquisition, we should immediately tell the examiner with a lot of clarity that as far as A and as far as B is concerned, you can say he is the legal acquirer. Though it is already given in the question, but tell the examiner clearly he is a legal acquirer, but he is supposed to be an accounting acquiree. He is supposed to be an accounting acquiree. And as far as B is concerned, he is a legal acquiree. He's supposed to be a legal acquiree, but from the accounting point of view, he's supposed to be the accounting acquirer. So tell the examiner very clearly that what is the status of A and B based on the percentages, that A is the legal acquirer, but accounting acquiree. B is supposed to be the legal acquiree, but he's an accounting acquirer. So we've identified in step number 1, who is the accounting acquirer. Now, a big caution, friends, hear me carefully. Many people at times say, so what is the need of step number one? Why did you actually calculate a percentage of 40% to prove the point that B is supposed to be a legal acquirer? If the examiner is already telling you that it is a reverse acquisition and B is an accounting acquirer, why are you wasting time in the exam and calculating this post-business combination percentage? Caution, friends, caution. In this case, trust me, I would be needing this 40% calculation later. When I'm going to calculate a purchase consideration, I would need that 40%. So even if the examiner, tells you the fact that it is a reverse acquisition, good enough. He's helping me and he's telling me it's a reverse acquisition, but that doesn't mean that you don't calculate this percentage. This percentage has got a very important role in the calculation of the purchase consideration. So you need to do the step number one, even if the examiner tells you, Basanti, tumhara naam kya hai? So you say, yes, it is Basanti. I am still calculating the percentage. I hope you got the point. Now, this role of 40% will very shortly come. Okay, so this is step number one, and then we go on to the step number two. And in terms of the step number two, we need to get the date of acquisition. And the date of acquisition is very clearly given in the very first sentence itself. It says on 30th September X1. So that is the date of acquisition, 30th September X1. Okay, and then I think I just need to apply the step number three. And in terms of step number three, there are two sub-steps. Fortunately, unfortunately, I've not seen the application of Ind AS 12 in terms of reverse acquisition as well. In the cases of reverse acquisitions, fortunately, unfortunately, no tax rates are given. Now, you're going to tell me, so please find out a question where a tax rate is given. But in any case, I could not get hold of that. So let's go with the safety, no tax rate, no Ind AS 12. So we get on to the step number three. And in terms of the step number three, we're basically doing just step number 3B. Because tax rate is not given, so we are not applying the concept of Ind AS 12 in the absence of any tax rate which is given in the question. Now, in terms of the step number 3B, we need to make a list of net assets. And when you make a list of net assets, remember, this is the net assets of accounting acquiree. Let's get the focus very clear that this is the list of net assets of the accounting acquiree, which in this case is entity A. And that's the reason when I started reading the question, it very clearly said net assets of A, the fair value and the book value is same, except for non-current assets, he gave you a fair value. So which means that once we're making a list of the net assets, you need to focus on the accounting acquiree. So let's go to the balance sheet of A. Let's pick up the item by item. Though, if there is any fair value, we'll take that. So we are given, first of all, there is a current assets that is 500. Then in the balance sheet of A, we are given a non-current assets, and we are given the fair value in the additional information, that is 1500. Of course, when you consider the net assets undoubtedly are taken at a fair value. So the only asset with a fair value is the NCA, that's 1500. And that's it on the asset side. So we reduce the liability. And on the liabilities, I'm given the current liabilities is 300. And there is a non-current liability, which is 400. Fortunately, unfortunately, again, we don't have any items of exceptions. If you look at the step number 3B, I'm not given any exceptions, contingent liability, indemnification assets, etc. Nothing is given. So we get the net assets as well. And I guess so far, so simple. So this works out at 1300 is the net assets. I don't think so that there has been any complications so far in terms of the step number 3. Pretty simple. Your step 1 was absolutely similar what we do. Your step number 2 and 3 absolutely similar, no changes. Now comes the most crucial step, and that is step number 4, that is calculation of the purchase consideration. Now, here I need your 100% attention, friends, because what I'm about to now discuss could be a little complicated and it could, put a little pressures in your mind. But you will understand this 100% terms and conditions apply. The terms and condition is that I need your 100% full attention at this point of time. So just hear me very carefully. Each and every word of what I'm going to say right now is going to be very important indeed. I'll also take you to the study material regarding the calculation of the purchase consideration. So hear me very carefully at this stage. In order to give you a clarity of thought as far as the reverse acquisition is concerned, for a moment, let's assume that if this is not a reverse acquisition, mind you what I'm saying, I'm just coming out of this question and I want to first of all tell you that if it is not a reverse acquisition, I'm just giving you an explanation that if it is not a reverse acquisition, so I'm calculating a PC the way we used to do in case of acquisition accounting. So if it is not a reverse acquisition, it is undoubtedly a case of acquisition accounting. It is undoubtedly a case of acquisition accounting. So in this case, we're saying A is supposed to be the accounting acquirer. I'm taking the same data, but let's consider that A is the accounting acquirer. So how do you calculate a purchase consideration? We will consider the fair value of the shares issued. So we will consider the purchase consideration is the fair value of the shares issued. We need to consider the fair value of the shares issued. So let's consider in this case, how many shares did A give to the shareholders of B? 150 shares. So in this particular case, 150 shares were given by A to the shareholders of B. And let's see what is the fair value of A company's share. A gave 150 shares to the shareholders of B. So we need to get the fair value of the number of shares given. If you go to the question, the fair value of the share of A is given to me 16 rupees per share. So this will give me the purchase consideration. So 150 shares issued at a fair value of 16. This is the purchase consideration. I don't think so this would be of any concern to anyone. I don't think so there would be any confusion that if it is not a reverse acquisition, this is what we used to do. Okay, now we're going to change the same. Now I'm saying if it is a case of reverse acquisition, so I'm saying yes, it is a reverse acquisition. If it is a reverse acquisition, then of course we are applying reverse acquisition accounting. So we are applying a reverse acquisition accounting in this case, and we can say B is the accounting acquirer. B is the accounting acquirer in this case. Let's get the focus very clear. So when you say it is a reverse acquisition, then the accounting, the B is treated as a, you can say, accounting acquirer. Now, hear the words carefully. Did B pay any consideration? No. But I need to now visualize. I need to now visualize if B would have paid a consideration. So we are trying to, put that question to ourselves. If B would have paid a consideration in order to maintain the same percentage which he got now. Remember the step number one, that A got a 40% stake post business combination. So B indirectly got a 60% stake. The shareholders of A got a 40% stake. So the shareholders of B got a 60% stake. So I want to put across a question to myself. If B wanted to maintain this percentage, if B wanted to maintain this percentage, how many shares he would have issued in his own company? Now, if you look at the shares of B, company B has got 60 shares in his own company. And let's assume that he would have issued X number of shares to the shareholders of A. 60 is the number of shares of company B shareholders. And if I assume that what would have been the capital of B if they would have issued the shares to company A. So let's assume that B would have issued X number of shares to the shareholders of company A in such a way that his own stake would have come to 60%. Get this very clear, that you need to put across a question. By this particular arrangement, the shareholders of B are getting a 60%. Where do you get that 60% from? Step number 1. To remind you, if I just go back to the step number 1, in terms of the step number 1, we just saw that the shareholders of company A is getting a 40% stake, which means the shareholders of B are getting a 60% stake. And that's the reason I said this percentage is important in order to calculate a percentage. Even though the question told me it's a reverse acquisition, but unless I calculate this percentage, I cannot calculate a PC. So I took this percentage as a base, that what B wanted. B basically wanted that he should get a 60% stake in post-business combination situation. So let's assume if B would have issued the shares to the shareholders of A, let's say he would have issued X number of shares so that he maintains the same percentage of 60%, calculate the value of X. If you calculate the value of X, it comes to 40 shares. If you calculate the value of X, it comes to a total of 40 shares. So what we are trying to calculate is how many shares would have been issued to maintain the same percentage. So if somebody were to say that what is a purchase consideration in a reverse acquisition, I would say, okay, let's take the fair value of shares. Let's take the fair value of shares which would have been issued. Which would have been issued. So we need to consider what would have been the fair value of the shares, and that's the focus, which would have been issued. So like here, I'm considering the shares issued. Here you need to consider the fair value of the shares which would have been issued to maintain same percentage. To maintain the same percentage, there is 60%. If B wanted to maintain a 60% stake in the company, in the combined entity, then he would have issued 40 shares to the shareholders of company A. So if I calculate the PC, he would have given 40 shares to the shareholders of A company. And what is the fair value of company B? The fair value of company B is 40. So this comes to 1600 is the PC. I hope you got the point, friends, at this stage. Let me see if any further questions coming to your mind in this case. Okay, no confusion so far. That's wonderful indeed. But still, let me consolidate the picture because I'm still not done with the purchase consideration. There is something more which I need to tell you at this stage. Let's first consolidate. This is what you've been doing in acquisition accounting, that when you calculate a purchase consideration, you basically consider that, okay, what is the number of shares issued? Let's take the fair value. So the acquirer company issued 150 shares and the fair value of each share is 16. This is the consideration. This is only if it would have been a case of acquisition accounting. So when you look at a reverse acquisition, the standard says that, A gave a consideration, but sorry, is not an acquirer. The consideration is received by the shareholders of B, but they are the accounting acquirer. So I need to consider, okay, if B would have, the question is if B would have issued shares to the shareholders of A in order to maintain the same percentage, how many shares he would have issued? So we calculate that he would have given 40 shares in his own company and the fair value of each share is 40. That works out at 1600. Okay. Now, let me just come back. Which means in terms of the purchase consideration, when I'm calculating the purchase consideration in this particular case, we are considering the fair value of shares, which would have been issued. The fair value of shares which would have been issued. So we need to consider the fair value of the shares which would have been issued, which is 40 shares in B, and each share is worth 40. So the consideration works out at 1600. But the journey doesn't end here. If you read the standard, this guidance of purchase consideration is given. This guidance of purchase consideration, if I rightly remember, is given in the para number B20 in the appendix of B. If you want to correlate the language, the para number is not relevant for you. But if you want to see the guidance in terms of how the consideration is computed, the para number B20 of the standard gives us a guidance in terms of how the consideration is computed. But there is another very interesting para which is given in the standard, that is para number 33. So you don't need to remember the para number, but I'm just giving you an insight. And if you look at the standard in terms of para number 33, there is another very interesting input which is given. Now hear me carefully again. Para number 33 says that if your purchase consideration is only in shares, it doesn't say primarily. It doesn't say primarily. It says if the purchase consideration is only in shares. It says that if the purchase consideration is only in shares, then it says that the purchase consideration should be something like this. Now watch me. If I say that I acquired the shares of your company and against which I issued shares, please mind the language carefully. Let's say it is not a reverse acquisition. Let's say it's not a reverse acquisition. I'm just coming back to the agenda. Let's assume it's not a reverse acquisition. So what A did, it got a control over the company B, and in lieu, it gave its own shares. Company A said that I will give you 150 shares. So company A said, I'll give you 150 shares and get a control of your 60 shares. So what did you issue? 150. What did you acquire? A control over 60 shares. I repeat, there are two aspects of the transaction. What you give is 150 and what you acquire is a control over 60 shares. So the standard in para number 33, the standard in terms of para number 33 tells you that if the consideration is in shares only, the purchase consideration should be not the fair value of shares issued, but the fair value of the shares acquired. So they say this is more reliable in measurement. You know, if you remember in terms of Index 16 on a PPE, when you acquire an asset by way of exchange, there are two aspects of the transaction: the fair value of what you give and the fair value of what you acquire. And depending upon the circumstances, we consider either of the two. But I'll not get into all that. But there are always two aspects of the transaction. One is आपने क्या दिया, बदले में आपको क्या मिला. So मैंने क्या दिया? I gave 150 shares to the shareholders of B. So क्या दिया? Issued. Para 33 says that if the consideration is only in share, ये मत देखो कि क्या दिया, ये देखो कि आपको बदले में क्या मिला. It is more reliable in nature, which means you need to take the fair value of the shares acquired. Company A, by issuing 150 shares, got a control over the 60 shares of B. And each share of B is worth 40. So this comes to 2400. And of course, this is exactly same. So, but if this is same, is it by chance the same, or is it got to be same? What is the issue out here? Well, I think if you notice in this particular case, let me tell you something interesting. the fair value of company B is 40 and the fair value of company A is 16. If you divide 40 by 16, it comes to 2.5. The ratio of exchange in this case is based on the fair value of both the company's share. The fair value of company B is 40. The fair value of A is 16. So company B has got 2.5 times the fair value of A. If company B has got a fair value 2.5 times, the exchange ratio is based on that fair value. So at the end of the day, whether you consider what you gave or do you consider what I got, it's going to be the same thing. So this is coming to be equal. This is coming to be equal only because the exchange ratio is based on, you can say, the fair value of the shares, a perfect situation. But if this would not have been the case, then this answer would not have been 2400. So in this particular case, the standard says that what is more reliable as a calculation is considering what you got instead of considering what you issued. But it is a case of reverse acquisition. It's a case of reverse acquisition. So I need to come back to the concept of para number 33. So what does para number 33 tell me now? The para number 33 tells me, you know what I did? The fair value of the shares which would have been issued. Then I should consider that the fair value of the shares on which I got a control. So what did I get in return? So we need to see the fair value of shares, over which control is acquired, over which the control is acquired. So instead of considering what would have been issued, you consider what did you get. The same funda would apply. Instead of considering that what you would have given, let's now consider what you would have got. So if B would have given 40 shares to the shareholders of A, he would have got a control over the 100 shares of A. By giving 40 shares to the shareholders of A, he would have got a control over the 100 shares of A, and the fair value of A is 16, and that works out at 1600. Oh, this 1600 and this 1600 is again matching. And I've already given you the reason why this 1600 is matching, because in this particular case, the exchange ratio is purely based on the fair value. Sir, now this is getting a pain on the nerve. You did 4 permutation combinations early in the morning. Do you feel, that we are not so big people? We are just small children. We might be in CA final, but we are still small children. Don't you feel bad when you speak so technical things early in the morning? It reminds me a very interesting dialogue in a movie which said in Munna Bhai MBBS, when he comes to the class and addresses the students that I don't love my patients. He said, the moment I love my patients, then I can't treat them. I think it's same goes out here. If I start loving you as students, then I think I can't give you pain. No pain means no gain. Okay, anyway, I think we'll consolidate the picture. This might be a little tricky, but it's not that tricky as well. So let's get the fundas very clear. I'm going to consolidate the picture, but I'm sure there might be some questions coming in between as well. Is there? Okay, I think Namrata, you said, so can't for every 2 point shares, we say 1 share. Okay, let me just consolidate the picture and let's get this very clear. So I'm just going to consolidate the picture to you. And you would now say, so what is to be shown in the exam, this or this? In the study material, of course, both these elements have been clearly shown. I think I just like to take you to the study material first of all, and then do a consolidation of this. This is the only tricky part in terms of reverse acquisition. Let's do one thing. Let me just take you to the study material. And I just want to show you how the calculation of the purchase consideration is being reflected, so you get a fair idea. So this is the question in the study mat, and I'm just going to share the solution to you to get a little fair idea on things. So let's have a look at this so we get a good idea in terms of things. So this is page number 13.121. I'm looking at the page number 13.121 in the study material. Let's have a look, friends, on this. Just have a look at this. I'm just going to read what is stated in the answer. Calculating the fair value of the consideration transferred, if the business combination had taken the form of B issuing additional ordinary shares to entities A shareholders in exchange, it says B would have issued 40 shares for the ratio of ownership interest in the combined entity. He's basically telling you the same thing on the presumption that the B would have issued the shares to the A in order to maintain the percentage. That is, if he wants a 60% stake in the company, then what is the status? Let's have a look. It says entity B shareholders would then own 60 shares out of 100 shares. That is 60% of the combined entity. I've already shown you the detailed calculations that if B would have issued the shares to the shareholders of A, he would have given them 40 shares to maintain that 60% stake. And therefore, the fair value of the consideration is 1600, 40 shares into 40 rupees per share. And now you can see that this is a mention. This is the mention in terms of the para number B20, and this is the mention in terms of para number 33. And see what it says. The fair value of the consideration effectively transferred should be based on the most reliable measure. Here, the quoted market price of A provides a more reliable basis for measuring the consideration effectively than the estimated fair value of the consideration to be what you give. You start considering what you got. So by giving 40 shares to the shares of shareholders of A, you get a control in terms of 100 shares of A. So that becomes a more reliable basis. Though in this particular case, the answers as per both is same, and I gave you the logic as well. So in the solution, of course, a mention of both of them is done. Therefore, I give you both of them. So I would say in a reverse acquisition, considering that if the consideration is only and only in terms of equity shares, you could reflect the consideration by both the things, B20 as well as the para 33. Now let me just come back. And take you further. I'm just going to consolidate the inputs quickly to you, so that we're very crystal clear on the calculation of the purchase consideration. So let's come back. And let's consolidate the learning in terms of the calculation of PC. Now, watch this very carefully, friends. So I have basically given you 4 permutation combinations in terms of calculating a purchase consideration. So let's watch out the 4 permutation combinations in this particular case. Now watch this carefully. So I can say that I'm looking at a situation if it is not a reverse acquisition, but a case of acquisition accounting. In which case I'm looking at that if you calculate a PC using the normal situation, and then I'm looking that if I say that para 33 is applied, but remember, para number 33 triggers only when the consideration is only in shares. Para number 33 triggers only when the consideration is only in terms of equity share. Now let's get this very clear. If it is not a case of reverse acquisition, normally what do you ask? What did A give? Look at the stress of the word. What did A give to the shareholders of B? He said, I'll give you a total of 150 shares in my company. So this is what you gave. Let's put it like this. This is what you give. So A said, I'll give you 150 shares in my company and each share is worth 16. Done. This is one. So the normal way of looking at is what did you give them? The second way is what did you get in return? So what did you give? And the other way is to see what do you get? So either you see what you gave or you see what you get. So what did you get? By issuing the shares to the shareholders of B, you got a control over the 60 shares. Now you own those 60 shares. So I gave 150 shares in my company. In lieu, I got 60 shares in their company. So the fair value of 60 shares comes to that. This is the case of when it is acquisition accounting. Now let's go to the next one, and we're looking at that if it is a reverse acquisition. Now, if it is a case of a reverse acquisition, now your thought process is that you need to see what would have been given. So here again, the focus is in terms of what would have been given. What would have been given. So the focus out here is आप क्या देते, इधर है जो दिया और इधर है जो देते. So in this particular case, you're looking at what? That B would have given to the shareholders of A 40 shares. So let's take the fair value of those 40 shares. That B would have given 40 shares in his company. And what is the fair value of that 40? So that works out at 1600. The other part is that you see that when you say you would have given 40 shares to the A, what would you have got? And you actually got a control over 100 shares. So here again, the focus is in terms of what you get in return. So the focus is you would have given 40 shares, and by giving 40 shares, you would have got a control over the 100 shares of company A. So take 100 shares into the fair value of those shares, you get a purchase consideration. In the exams, as I said, it would be preferable in a reverse acquisition only if the consideration is purely in equity shares. See what would have been given and see what did you get in return and calculate the purchase consideration. I hope, friends, I am crystal clear on all the four combinations. Intentionally, I've shown you the case of acquisition accounting and the case of reverse acquisition. How do you calculate a PC? So PC is 1600 in this case. Right, I guess I'm pretty clear, friends, on this. Do let me know if you've got the entire concept correct. I know this was a technical bit, but it was not very technical indeed. So focus is what you gave and what do you get. The focus is in reverse acquisition, what have been given and what do you get in return. So the reliable basis is not what you give. The more reliable basis is what do you get. That is more important in terms of PC. Okay, I hope this is clear. Do let me know if this is clear to everybody. Just send me a message and let's see if this is clear. So the step number 4 is taken care. Yes. Then let's go to the step number 5. So basis this, we're going to the step number 5. And in terms of the step number 5, we've got NCI. And I've already pinpointed at the very start itself that in this particular case, there is no NCI. Okay, perfectly clear. Wonderful indeed. That is superb. Okay, now looking at the step number 5, there is no NCI. So step number 5 is done. Then we need to go to the step number 6, which is the calculation of the goodwill or the bargain purchase gain. Now, in terms of calculating the goodwill, the technique, everything remains the same. There are no changes. So we will take the purchase consideration, and that was 1600. There is no NCI. So this itself represents 100%. And we compare this with the net assets. And I guess we computed the net assets in step 3 as 1300. So we get the difference 300 as the goodwill. So this is, as far as the step number 6 is concerned, absolutely similar to what we've done. I'm done, friends, now. I will not look at any journal entries now. We'll directly now make a consolidated balance sheet itself. Now, a few watchful things again at this stage. Sorry. Now, when I'm making a consolidated balance sheet, I didn't tell you one thing earlier, but I think one of my friends, asked in the morning, Prashant, asked me, And I think I want to give you a small little further connect to get a clarity of thought. So before I come to the consolidated balance sheet, let me, I think, give you a very interesting connect. So you're able to connect with things as well, getting the dots clear. See, there is a company A Limited and it gets a control over B Limited. So let's say there is a company A which gets a control over the company B. Now, if I look at, let's say, the balance sheet of company A, let's say this is the balance sheet of A, and this is also the balance sheet of A. But the difference is, this is the separate financials of A, and this is the consolidated financial statements of A. We said this earlier as well, that when A gets a control over company B, A is supposed to make two financials. One is a standalone financials, but we don't call them standalone. Technically, we call them as separate financial statements. So he will be making a separate financial statements by virtue of Ind AS 27. And he would also be required to make a consolidated financial statements by virtue of Ind AS 110. So he would be required to make a separate financials, and he would also be required to make a consolidated financials. Now, we'll be learning the art of consolidation later. But let's first of all visualize this. When A made an investment in B, what did he do in the balance sheet? He recorded the investment in B in the balance sheet. He basically did the entry that is investment was given a debit. And let's say the consideration was paid in cash. So this is the entry which was done in the books of A. That is the separate financials, investment, debit, and bank credit. And therefore, this investment appeared in the books of accounts. Now, what do you do? The moment we say that A got a control over the business of B, I said, okay, now what do you need to do in this particular case? You need to apply acquisition accounting under Ind AS 103. So you apply the concept of acquisition accounting under Ind AS 103. Now, when you do the acquisition accounting, you are basically passing the entry assets of B and liabilities of B. So net assets are taken over, and the purchase consideration, which is the investment, in this case, indirectly is given a credit. And you get a balancing figure, which is supposed to be a goodwill, and you get this as a balancing figure. So you look at an acquisition accounting entry where you record the net assets of B. So these are the net assets of B at fair value. And you consider the purchase consideration, compare the net assets versus PC, you get a goodwill. So basically, if you see, what are you about to do? In this particular case, what you're technically doing, if to this balance sheet you add this entry, you are going to get a consolidated financial balance sheet. Because in this case, what would happen? This investment will get cancelled because the investment, which is a debit balance, is getting credited in this entry. And if you incorporate this entry in the separate financial statements, what is happening? The investment is gone. The goodwill comes in its place. With the assets, you aggregate the assets. With the liabilities, you aggregate the liabilities. So what are you doing? You'll see very soon is a consolidation. Because when you incorporate this entry in the balance sheet of A, the separate financials, you can say that Ind AS 103 is indirectly acting as a bridge. It is indirectly acting as a bridge between the separate and the consolidated financial statements. And this is the consolidated balance sheet, which you get on the date of acquisition, because this entry is also done on the date of acquisition. So indirectly, you can say that the moment you do an acquisition accounting, one could simply say that this is the balance sheet of A, and in the balance sheet of A, incorporate the acquisition accounting entry. It's like an adjusting entry in order to make a consolidated financials. We'll see another way of doing it also when we come to Ind AS 110. But you can see that now you get a connect that Index 103 is nothing, but it is inserted in the Index 27 balance sheet. And the moment it is inserted, your product, the final product is a consolidated balance sheet as per Index 110 on acquisition date. Right? I guess you got the connect now in terms of 27 and the other things. Okay, Janvi, you said, so can you please make a flow chart summary for the purchase consideration? Okay, I'll do that. Not an issue. After the end of this question, I'll do that. I'll just make a mind map telling you what are the 4 permutation combinations, of course. Okay. So now let's come back. So basically, now if I want to make a consolidated balance sheet, what do I need to do? I need to basically, incorporate in the balance sheet of B. For the consolidated balance sheet, what I need to do, the consolidated balance sheet will be prepared taking B company, who is an accounting acquirer, as a base. So we're going to consider B, the acquirer, the accounting acquirer, as a base. And to this, we add the net assets of A. And I need to add the goodwill. So once you incorporate in the balance sheet, in the separate financials of B, you incorporate the goodwill, incorporate the net assets. Can I say you are going to get the consolidated balance sheet, right? The same logic that in this particular case, you're considering B as a separate financials, insert, replace that investments, which is not there technically, but replace that investment, which is in the balance sheet of A actually, replace it with the net assets and the goodwill. So let's begin. So I'm going to start with the asset side of the balance sheet. And in terms of the asset side, let's take the non-current assets. So we're given the non-current assets. Now be careful. I'm going to consider B. I'm going to consider A. So when I'm going to consider A, they need to be taken at a fair value. Because the accounting acquiry is A, so you need to consider the fair values of A and not the fair values of B. So if you take the non-current assets of A, it is appearing at 3,000. And if you take the non-current assets of A, it has got a fair value of 1,500. So the final figure you get is 4,500. This is the final figure of B. So what I'm doing aggregation. The net assets, non-current assets of the accounting acquirer at a book value and the accounting acquiry at a fair value. Least we forget there was a goodwill. I guess the goodwill was to the extent of 300. Then on the asset side, the only item given is the current assets. So B, the current assets are 700. A, the current asset is 500. So the total works out at 1,200. That's it. The asset side of the balance sheet is done. So this works out at 6,000 is the balance sheet on the asset side. Now let's go to the equity and the liabilities section. So we've got equity and liabilities. And in terms of equity, let's consider equity share capital. Now. At the end of the day, the legal acquirer is A, and the consolidated balance sheet is technically being prepared by A. So if you ask me that this consolidated balance sheet is of which company, it is the balance sheet of A. Because A is the legal acquirer, so the legal responsibility in terms of making a consolidated balance sheet lies on A. Though from the accounting point of view, when you're making the balance sheet, you're taking B, accounting acquirer, as a base and inserting the accounting acquiree's assets and liabilities at a fair value. But ultimate responsibility in terms of presenting the console is of the legal acquirer, which is A. So the standard now gives us something very interesting in terms of the equity share capital. When you go to show the equity share capital in this particular case, the question arises that what is the number of shares which are going to be represented in the balance sheet? The number of shares is A had 100 shares and he issued 150 shares. You cannot show something which would have been issued. The number of shares in the balance sheet cannot be on the basis of what would have been issued. A actually issued 150 shares. So as far as the number is concerned, the number is going to be a total of 250. The shares which A had and the shares which A actually issued the shareholders of B, there is 250 shares. But when it comes to the amount, I am doing everything from the point of view of the accounting acquirer. We're doing everything from the accounting acquirer's point of view. So if you look at the balance sheet of B, the share capital of B is 600 and the purchase consideration is 1600. So moral of the story, very, very important, that when you make a consolidated balance sheet in a reverse acquisition, the number is taken from the legal acquirer point of view. The number is taken from the legal acquirer point of view, but the amount is taken from the accounting acquirer point of view. Don't worry, I'm going to give you a mind map immediately after this question on the key considerations to be kept in mind. So when you take the number, the perception is legal acquirer, because number cannot be notional in number. Number is what is actually issued. But the figures all which are being taken is from the point of view of the accounting acquirer. So when you're considering the balance sheet, the figures, the amounts are from the perception of B being the accounting acquirer. But when it comes to the number, you need to consider the legal acquirer. Then next in the balance sheet, we are given the retained earnings. And in this particular case, as far as the retained earnings are concerned, we're going to consider the retained earnings only of the acquirer, the accounting acquirer, which is supposed to be 1400, because in the acquisition entry, you are not supposed to take any retained earnings. You just took over the net assets, no retained earnings. So this is again only for company B. And then we've given the liabilities. There is non-current liabilities and there is current liabilities as well. So this is the equity and the liability side. On the non-current liabilities, we take B, that is 1100, and plus A, that is 400. So that makes it 1500 is non-current liability, B plus A. Similarly, the current liabilities of B is 600 and A is 300. The total works out at 900. So this will give me the total of my consolidated balance sheet total. So let's see. This is working out, I guess, at 2200 is the share capital. So 2200 plus 1400 plus 1500 plus, 1500, 1400, 900 and 2200. This is a perfect total of 6000. The assets and the liabilities are perfectly matched. My God, you would say it almost took us almost around a 1 hour plus. But this gives us a lot of nitty-gritties in terms of reverse acquisition. So now we just need to make a quick mind map of the special agendas to be kept in mind on the case of a reverse acquisition. Okay, let me see if any questions coming in between and then we take it further. Okay, and Janvi said, so in journal entry, assets will be a B, but it is the acquirer. Okay, I think let me just give you the focus once again, very clear. Let me just make a quick chart to you, giving you the insights in terms of what factors should go at the back of the mind in terms of the balance sheet, in terms of the PC. Let's make a quick chart. So let me do one thing. Let me just make a quick chart on this area. So I am making a mind map, friends, to you. So this is a small little mind map of the key considerations you need to keep in mind when it is a case of reverse acquisition. So when it is a case of a reverse acquisition, so what key considerations are kept? Well, I would say step number 1 or step number 2 or step number 3 doesn't pose any challenge. But I would still keep one thing in mind, that your key areas which you need to keep in mind is when you're working on step number 3, and you're making a list of net assets, when you're making a list of net assets at a fair value. So you need to get the focus very clear that this list is of the accounting acquiree. So not the legal acquirer. Sorry, not the legal acquiree. So the focus which needs to be very clear is that in this list of net assets, you need to consider the net assets of the accounting acquiree. You need to consider the accounting acquiree, which implies I'm looking at the legal acquirer. So this is one key focus point which you need to keep in mind, that when you consider the step number 3, get it clear. I need a list of net assets which is accounting acquiree, which is indirectly legal acquirer. That's one. Then I guess in terms of the step number 4, you need to be very careful on the purchase consideration. You need to be very careful on the purchase consideration. So as a part of this mind map itself, let's do one thing. Let's create a permutation combination charts to you. So let's do it like this. So this is a permutation combination chart so that everything gets absolutely clear. Okay, let's, I think, make this chart like this. So let's have a look at the permutation combinations. When it is acquisition accounting, when it is acquisition accounting, and when it is a reverse acquisition. When it is a reverse acquisition, and I'm looking at the para number, or let's forget about the para number. Why? Let's put the para number. So in this particular case, okay, here at least let me put it that if you apply the para number 33, and the para number 33 triggers only, it triggers only when purchase consideration is only in shares. So this triggers only when the purchase consideration is only in shares. So as a part of the reverse acquisition, let me give you the permutation combinations. When it is a case of acquisition accounting, in this particular case, what do we consider? Fair value of shares, fair value of the shares which is actually issued. Let's put it like this, so that you don't forget. You need to consider the fair value of the shares actually issued. So what is the shares you actually issued? You take a fair value of that. That is the purchase consideration. Okay, if I apply the para number 33, we would consider the fair value. So we would consider the fair value of the shares. We would consider the fair value of shares on which control is acquired. On which control is acquired. So you need to see what are the number of shares on which you got a control. So I think just to remind you back with the same example, A actually issued, just for remembrance, A actually issued 150 shares to the shareholders of B. So you take the fair value of those 150 shares. What did A get in return? Can I say he got a control over 60 shares? So either you say that we get the fair value of what you gave, or if para 33 is applicable, then the fair value of those 60 shares on which you got a control. Similarly, if I go to the reverse acquisition, we need to consider the fair value of shares. We need to consider the fair value of shares which would have been issued. Which would have been issued. So the question is making an assumption, and we are looking at which would have been issued. If B would have given shares to the shareholders of A to maintain a same percentage, he, in this example, would have given a total of 40 shares. So he would have given those 40 shares. So if you calculate the consideration, you need to consider not what is given, but what would have been given is the focus. And if you apply the para number 33, then in this particular case, we would consider, you can say the fair value of shares on which control is acquired. So this is correct. This is same on which the control is acquired. So we need to see that what is the number of shares on which the control is acquired. So when B would have issued shares, 40 shares to A, he would have got a control over the company's A share. So the shares of company A is to the extent of 100 shares. So this is what you do. So once you make a quick revision, you get a quick inputs on that. So this is all the permutation combinations, the mind map done. So what you need to concentrate on the PC is this part for the reverse acquisition. So this is on step 4. Then I think the only input required is further in terms of the consolidated balance sheet. So your focus point thereafter is the consolidated balance sheet. And when you're focusing in terms of the consolidated balance sheet, you need to be careful that when you consider the equity share capital, you've got a number and you've got an amount. So one of the focus to be kept in mind is when you consider the number is to be taken from the legal acquirer's perspective. The number is to be taken from the legal acquirer's perspective. That means you will consider the number from the point of view of the company A. Then what is the number of shares? 100. He issued actually 150 shares. But when it comes to the amount, it is from the point of view of the accounting acquirer. It is from the point of view of the accounting acquirer. And I think needless to make a mention that when you consider the assets and liabilities in this particular case, you need to consider the book value of the company B, because he is the accounting acquirer. So you consider the book value of B and you add the fair values of A. So as a part of the consolidated balance sheet, you need to consider the fair values of A, accounting acquiree, and you need the book values of B, which is accounting acquirer. The figures are all from the point of view of B. The number is from the point of view of A. So this is the crux in terms of the reverse acquisitions. Once you revise, friends, I guess you'll get amply 100% clarity on the same. Right, friends. So this was one case done. That is when a new entity is not being created. Okay, and Rahul, your balance sheet is tallied? Yes. What if your balance sheet doesn't tally things? What are the things to be kept in mind? Well, I think I've given you a list of all the key considerations. So I think if you're going to keep these considerations, I'm pretty sure the balance sheet would tally. I don't see much challenge. So I think with this, it's going to be quite a helpful exercise, I believe. Okay. Right, friends. So this is done. Now I am going to take you to another question on a reverse acquisition. And in which particular case, I need to give you that if a new entity is created, then how do you tackle the calculation of the purchase consideration? So let's take you to another question now. So I'm just going to come back to this question is also there in the study material as well, but I'm just taking you to the assignment which I've shared with you. And let's have a look at this. So this is the question. So this is the question. Let me just enlarge this to you. So this is a question, a similar kind of question also came in the exam. It's there in the study material as well. So I think let's have a read with you on this question. Okay. So this is the question on a reverse acquisition where a new entity is created, because I said there are two kinds of questions. One is a new entity is not created, done. Now we're looking at if a new entity is created. It says AX and BX amalgamated from 1st January and a new company ABX is created with shares of 10 rupees formed to take over the business of the existing company. The moment you read this, immediately what comes to the mind is you created a company with shares, the consideration is in shares, and a new company is created, undoubtedly a case of reverse acquisition. So the balance sheet of the two companies is given, and then let's take it further. So this is a question which is in the study material, also came in MTP October 18 as well. So I think let's have a look at further inputs given in the additional information. It says ABX issued requisite number of shares to discharge the claims of the equity shareholders of the transferor companies. Also, the new debentures were issued in exchange of the old series of both the company. We're required to prepare a note showing the purchase consideration and the discharge and the draft balance sheet of the company, assuming both companies are under common control. I'm yet to do the common control. So for the time being, we're not looking at requirement A. I'm yet to do the common control accounting, which is the next agenda. Assuming BX is a larger entity and their management will take over the control of ABX, he is already given you that out of the existing company, BX is a larger company, and therefore the existing company BX gets a control, which is indirectly saying that it is a reverse acquisition. Do I need to do the step 1 calculations in order to identify the accounting acquirer? So yes or no? The examiner is very clearly telling you that BX is the larger entity and he is getting a control. Indirectly, he's very clearly told me that out of the 3 companies, one of the existing company, which is the accounting acquiree, becomes a accounting acquirer, which is supposed to be a legal acquiree, becomes an accounting acquirer. So do I need to go to the step number 1 and tell the examiner and prove it that, he is supposed to be the accounting acquirer, or I could directly get my journey to step number 2? What do you say, friends? I want your inputs on that. Let's ask you this. Do you think I need to go to the step number 1 and do my calculations? Let's see what's your inputs on that. I'm just waiting for your inputs on this. So do you think I need to get on to the calculations in terms of step number 1 and identify in this case and prove it to the examiner that who is supposed to be the accounting acquirer? Okay, I think maybe the journey of answers going a bit slow. So I think maybe I'll have to answer that question, because sometimes the question net could create a little lag, I guess. Well, the answer is, of course, a yes. If you remember what I said a few minutes back, the percentage which you calculate in terms of step number 1 is very crucial in terms of calculating the purchase consideration. You cannot take chances. You need that step in any case. Okay, we got the answer right, Janvi. That's absolutely correct. Yes, we need it. Wonderful indeed. That's great. Okay, so let's do one thing. Let's start solving this question, friends, with you. So and this is also a question which is given in the study mat. And if I rightly remember, a similar kind of question has also come in the exams as well, quite recently in the exam. Okay, so let's work out the answer to you. So I think my major concentration is on the purchase consideration calculation. The rest, I think, should not be an issue. So I think I'll just do up to the calculations of, without making a balance sheet, let me just do the basic calculations with you. So I go to the step number 1 in order to identify who is the accounting acquirer. So let's go to the, first of all, the accounting acquirer. Now watch this carefully. Now, if you look at the data which is given in the question, I would first of all look at, in the question, we are given the fair value of the business of the 2 companies. So there is a company AX and BX, and in the additional information, the fair value of the business is given. So I'm given what is the fair value of the company AX and BX. So in the additional information, the fair value of A is 11,000 and the fair value of B is 14,000. And the company ABX will issue shares. So the face value of the company ABX is supposed to be 10 rupees per share. So naturally, we need to now identify how many shares would the new company give to the shareholders of the existing company. He says very clearly that ABX issues requisite number of shares to discharge the claims of the equity shareholders. So how many shares would he give? Let's divide this by the face value. So we get the number of shares which are being issued to both the company shareholder. So company AX shareholders will get 1100 shares and BX will get 1400 shares. the total number of shares issued by the company is supposed to be 2,500. Okay, now considering that the new company is being created with a number of 2,500 shares, let us see what is the percentage of both these companies. If you look at the percentage in this case, he is getting 1,100 shares out of 2,500 shares. Let's see the percentage. So 1,100 divided by 2,500, it comes to 44%. And therefore, it implies that he gets 56%. So he is getting a control over the company because he has got more than 50% voting power in this particular case. Wow. The question was already telling me that BX is a larger entity and therefore it gets a control over ABX, but we proved it with a percentage as well that BX has got a 56% stake, which proves that in this particular case, you tell the examiner that this is undoubtedly a case of reverse acquisition. And also tell him that in this particular case, BX is accounting acquirer. So give the conclusion that he is supposed to be the accounting acquirer, and it is undoubtedly a case of reverse acquisition. And I've already maintained that when a new company is created, we can undoubtedly say that it would be a case of reverse acquisition. Okay, then let's go to the step number 2. So then we go to the step number 2 and look at the date of acquisition. So let's get the date of acquisition. And I think that's very directly given in the question itself. At the very first start, it is given that they were amalgamated on 1st January X2. So that is the date of acquisition. And then I go to the step number 3. And in this particular case, again, I am not given any tax rates in the question. So the concept of Ind AS 12 would not apply. We directly get onto the list of net assets. Focus. Now the focus is, if you're considering the list of net assets at a fair value, now the question rises that the net assets will be for which company? May I take the liberty of asking you which company? Are you considering AX? Are you considering BX? Or are you considering ABX? Well, ABX is just a new company. So when you're considering the net assets, BX is being identified as the accounting acquirer. So who is going to be treated as an accounting acquiree for the purpose? I'm sure you can identify this very easily. Of course, the answer in this particular case is AX. Okay, so we take this further, considering AX. So I'm going to consider AX for this purpose. Let's now look at the balance sheet of AX, and wherever the fair values are given, we'll pick them. So I am given a PPE, and the fair value is given in the additional information, that's 9,500. Then I'm given the next item on the asset side is investments, and investments I'm not given a fair value. So I take the book value in the absence of the fair value. So that's 1050. The next item is supposed to be inventory, and the fair value is 1,300. So this is the fair value of inventory, that is 1,300. And the next in the balance sheet is a trade receivable. I'm not given any fair values. So we take a book value as good as fair value, that's 1,800. And we are also given the cash and the cash equivalents, that is 450. So we take the book value. Cash equivalents as it is, the fair value cannot be different. That's all on the assets side. Then on the liability side, we've got number 1, a 12% debenture. So 12% debentures, no fair values are given. So we take the book value, that is 3,000. And the further liability is a trades payable, that is 1,000. So we will be able to get the net assets in this case. So that's 9,500 plus 1050 plus 1,300 plus 1,800 plus 450. minus 4,000, that works out at 10,100 is the amount of consideration. Okay. Step number 3 is done. Now we need to go to the main crucial step, that is step 4, the calculation of the purchase consideration. So let's go to the step number 4, that is the calculation of the purchase consideration. Well, I'm not considering the application of the para number 33 because I am pretty sure the results as per para number 33 is going to be exactly equal to the results of para number B20. Because in this particular case, when you're creating a new company and the shares are being issued on the basis of the fair value of the businesses, I don't see any challenge. So maybe you want to cross-check, you can do that. But I think let's apply only para number B20 in this case. Okay. So considering the para number B20, now the focus is I don't need what is issued. I need what would have been issued. So I need to calculate how many shares would BX issued to maintain 56% stake. So that is the question which we need to put across, that how many shares would BX would have issued if he wanted to maintain a 56% stake in the company. Now look at the balance sheet of BX and look at the number of shares in BX. The company BX has got a capital of 7,000, considering the shares are 10 rupees each. And I think it is given in the balance sheet, the share is 10 each. So the company BX has got 700 shares. Let us say he would have issued X number of shares to AX, such that the percentage maintained is 56%. So you need to do the calculations. How many shares would BX had issued had he want to maintain a 56% stake? So he has got 700 shares right now in the company. Let's say he would have issued X number of shares. Let's see what would have been the answer. I think if we solve the value of X, it is coming to 550 shares. The value of this is coming to a total of 550 shares. So I think I am done with the calculation. The moment I know that he would have issued a total of 550 shares, we can calculate the purchase consideration. 550 shares would have been given by BX, and I need the fair value of BX. So these are the shares which would have been given by BX to the shareholders of AX, and this needs to be multiplied with the fair value of BX. But I'm not given the fair value of BX directly, but not an issue. I am given in the question that the fair value of the company BX is supposed to be 14,000 is the fair value. And the company BX has got 700 shares, so we can say the fair value is 20. So I took the data that the fair value of the company BX is given to me. The company BX has got a fair value of 14,000 and they've got 700 shares. So the fair value per share is 20. So multiply this with 20 and you get the purchase consideration 11,000. Wow. Isn't this 11,000 equal to the fair value of the business of AX? Is that a chance or is it got to be? Of course got to be. Because at the end of the day, what BX would have given to AX to acquire, so he is acquiring a business which is worth 11,000. So naturally the purchase consideration has got to be 11,000. Here we have just basically got a breakup that 11,000 indirectly represents that 550 shares would have been issued at the rate of 20 and this would have been the consideration. I know you must be thinking, sir, why don't you apply the para number 33 as well? Okay, Rahul, you said, so do we ignore the DTA or the DTL in this case? Well, since I am not given a tax rate in the question, therefore the concept of deferred tax is not applicable. The questions which we have done so far on reverse acquisitions is got 2-3 very interesting, I would say, safety points. No NCI, and no tax rates given, and also the case, so I would say typically yes, no NCI and no deferred tax, the two. Because if I want a more reliable basis of measurement, then I should consider that not what would have been issued, but what is actually acquired by way of control. So BX, by issuing the shares to the shareholders of AX, is getting a control of the company. You want me to apply the para number 33 as well? Okay, I think I'm going to get the answer slightly later, slight lag maybe. So let's show you that. Why ignore it? Let's show you that. So let me show the workings on that as well. So let me show you that if I would have applied the para number 33, considering that in this particular case, the consideration is only and only in equity shares, let's consider what BX gets in return. BX gets a control over all the shares of AX, and the number of shares of AX in the company is 600 shares. So I need to multiply this with the fair value of AX. And here again, I'm not directly given the information of AX, but I can derive it. The fair value of AX is given 11,000 and the number of shares is 600. We can get the fair value per share. So 11,000 by 600, it comes to 18.33 per share. So if you multiply the number of shares over which I would have got a control, so BX by issuing would have got a control over 600 shares of AX, so 600 into 18.33, that also works out rounded off 11,000. Wow. But as I said, there are safety points all across. So we see whether you apply B20 or para 33, we get the same results in this case. So I think even if I restrict myself in terms of B20, I don't see challenge in terms of the exam. But yes, if you can, I think it's a good idea but remember, 33 triggers only when the consideration is only and only in equity shares. Okay, step number 4 is done. Then I go to step number 5. And in terms of step number 5, there is no NCI. And then we go to the step number 6, that is the calculation of the goodwill. And thereafter, I think the balance sheet can be done exactly on the same lines. So let's calculate the goodwill or bargain purchase gain. So in this particular case, there is no NCI. So we take the purchase consideration, that is 11,000. And directly compare this with the net assets. And I guess the net assets was to the extent of 10,100. So we're going to get a difference 900 as a goodwill. So that is my step number 5 as well. Sorry, step number 6. Then I think making the consolidated balance sheet should not be a big problem. I think that's manageable. Now, what you need to do, just apply the same parameters which I gave you. So what do you consider as a base? You're going to consider the company BX as a base, take the book values and add to this the fair values of AX and get the consolidated balance sheet of the company ABX. I think I'll leave that exercise to you. Okay, so far so good. I guess, friends, this completes my case of reverse acquisitions with you. And I think now I need to go to the last section of this particular index, and that is a case of common control. Pretty easy. The technical parts of the standard gets over because I think the most technical part was the acquisition accounting, the purchase consideration. And I think even in terms of reverse acquisition, the crucial part was in terms of the purchase consideration. So I think at this stage, I think I should give you a break before we start with the concept of a common control transaction. So I think let's do one thing. Let's give you a 10-12 minutes break. It's almost around 8:40. So let me see if any questions coming to your mind. No, I think so far so good. So do give me your understanding, your scores, comfort zones, scores in the break, friends. What has been your comfort zone on a scale of 10 on a reverse acquisition? Let's see how comfortable you are in terms of the learning on reverse acquisition. So let's give you a break, friends, 10-12 minutes, and we start back on the common control transactions with you. Welcome back, friends. So I think I got some comfort zone scores as well. That's great. I think Rahul tells me 9 by 10. Pranav tells me 9. That's great. That's wonderful indeed. Okay. So now we are going to go to the last section of this particular standard, and that is talking in terms of the common control transaction. Well, I think if you recall, when I started off with this particular index, I had given you that you can segregate the acquisition in terms of two areas. One is an acquisition which is with related party, and one is an acquisition which is with unrelated party. Now, in terms of a common control transaction, the basic idea is that this would trigger, typically you can say when there is a common, when you can say a related party transaction is there. So very interestingly, there has been some, you can say, a clause which has been inserted in the standard also, so that the abuse of the concept of common control transaction doesn't occur. Now, what kind of abuse I'm talking of, you're going to see when we look at the definition of what is a common control transaction. But let's first of all take a very basic example to understand what is a common control transaction, and then we'll take you to the definition, and then we'll see how the accounting is done when it is a common control transaction. The reason why the standard is taken a little different view in terms of a common control transaction is that when there is an acquisition with related parties, you can say in this particular case, we've given them a book value accounting. Your acquisition accounting or your reverse acquisition accounting is all based on a fair value approach. But when it comes to a common control transactions, when we say that the related parties are involved, a pooling of interest method, something what you've done in AS 14, a pooling of interest method which is based on a book value accounting has been allowed. So they've been, given the, you can say the advantage of doing a book value accounting instead of a fair value accounting. So naturally, the related party relationship should get established before we trigger the common control accounting. So let's first take a very basic example to understand the concept of a common control transaction. Now, let's imagine that there is a company AB Limited. I'm taking a very basic example to illustrate what a common control transaction would look like. So let's consider that there is a company AB Limited, and let's say it has got two divisions. One is a division A and it has got a division B. So part of the same company. So AB is one company with two divisions, A and B. Now let's consider that there is a shareholder, Mr. X, who's got, let us say, 80% stake in the company. He's got 80% voting power of this company, which means that he's got a control over this company. Now let's consider the company has got a certain thought process. Let's say, for example, division A is supposed to be a very profitable division. And let's say division B is supposed to be a loss-making division. So the company AB has got two divisions. One is a profitable division and one is a loss-making division. So what is happening in this particular case, when the company makes its financial statements, the losses of division B overpower the profits of division A, and the financial results are not very encouraging. So naturally, it would discourage companies to invest in this company. People will view that it's a loss-making company, though their core area of business is division A, but they also entered into a division B, but that's not a very core area, and they've been running losses into this. Naturally, the company's overall financial results are not very encouraging, so they need to do something in order that the financial statements, look good, and that's a genuine case. So what it does in this particular case, this company creates another company and it forms a company, let's say B Limited, and this company is created so that division B of AB can be transferred to B. So this is what we technically call that you are trying to demerge. So instead of merging, you're trying to demerge. So what the company does, it plans in for a demerger. It plans in for a demerger. So what it does in this particular case, it creates a new company altogether with a division B being transferred to this company. So what will happen in effect, that here only division A will be left over, and this company will be having a division B. Now, there is one thing which is very important, that if you create a new company B and the shares of B Limited are taken by AB, then in that particular case, B becomes a subsidiary of AB. So if AB is going to create this B and take over the shares of this company, B becomes a subsidiary. And then AB will have to consolidate the company B as well, because you need to make a consolidated financials. So the consolidated financials again would be very discouraging, because when he was making a separate financials, the results were discouraging. Even if he consolidates a loss-making subsidiary, the results are going to be equally discouraging. So naturally, he cannot afford that he creates this company as a subsidiary of the company AB. So what he tells the owners of the company, owners are, you can say, Mr. X and others. So he says that, okay, we're creating a new company and the shares of this company will be given to the existing shareholders itself. So the shares of company B, the shares of company B is given to the existing shareholders, is given to the shareholders of AB itself. It is given to the shareholders of company AB itself. So AB company doesn't keep the shares of this company. What he says, okay, we're going to create this company, but this company is going to belong. This company is going to technically belong to the shareholders of AB. So B is nowhere a subsidiary of AB. But at the end of the day, you can see the control is still with the existing shareholders. The existing shareholders X and others control AB, and the existing shareholders control B as well. So this is a situation where you can say that AB is under the control of X and even B is under the control of X. So you can say that before and after the business combination occurred, the companies which are involved in the transaction are under the common control. They were under the control of the same set of people. They're still under the control of the same set of people. The shareholders who controlled AB and the shareholders which control B are the same set of people. Therefore, it is a common control. So in this particular case, when you create a separate company B, it would be given the advantage in terms of applying the case of a common control transaction. So the basic thrust is that we want that pre and post business combination, before and after the business combination, we want that the control of the same set of shareholders continue. You'll get more inputs as I come to more example, but this was just to give you a very basic example of what exactly is a common control. That when a company is controlled by X and a new company is created which is also controlled by X, then the dealing between these two companies would fall under the common control. Since both the companies are before and after, even before it was under the control of X, even after both the companies are still under the control of X. So when the two companies AB and B are dealing in this transaction will be covered under the Appendix C, that is the common control transaction. I hope I made a bit sense. If not 100%, at least 70-80% sense. Let's take some more example. But before that, I need to first of all take you to the definition in terms of things. So let me do one thing. Let me now take you to the definition of a common control transaction. Let's have a look that how does the standard in Appendix B defines what is a common control transaction. So I'm going back to the study material and wherein I want to show you that what is a common control. So let's have a few look at examples as well. There are a few examples. I've also taken that in the assignment as well, where we're going to see how the concept of common control applies. Okay, so I think here I am. Just give me a second. I don't know if I deleted those pages actually or not. Maybe I think I deleted those pages. Okay, not a problem. I think I'll explain it. Otherwise, maybe in the editing, when I was editing these pages, maybe I just edited them out. So not an issue. I think I'll just explain the concept to you with my own examples, and we'll do a few examples also with you on this area. Just give me a second. I'll just take you back on the assignment to get the feel of a common control transaction. Yes, okay. Now watch these examples very carefully. I'm elaborating further before I come to the accounting treatment of common control transactions. Let me first of all give you an insight again that what kind of common control is there. Now let's look at an example and I'll illustrate the bits to you through this. Let's have a look. Let me just enlarge this. Okay, I think I can take it out here. Yes, that makes good sense. Now let's have a look at the question number 41. And let's have a look at the question number 42. So first I'm going to question number 41. Watch this carefully. So let's have a look at the question number 41. Now there are a few questions which I need to put across before we apply the concept of common control. Now watch this carefully. I'm just going to give you a very simple two-step model in order to decide that there is a common control. It says ABC and XYZ are owned by 4 shareholders, B, C, D, E, each of whom holds 25% shares in each of the company. This is B. Now you need to first of all visualize one thing, that there are a total of 4 shareholders, B, C, D, E. They've got a total of 25% stake each in company ABC, and they've got a 25% stake in company ABC, in company XYZ. So you can definitely say that nobody controls it individually. Please mind the words carefully. You can see that nobody controls the company, but you can see together they may jointly control the company, though we'll come to the concept of a joint control later when we come to Ind AS 111. But you can see one thing, that the companies are owned by 4 shareholders, and since each one of them has got a 25% stake, nobody has got a control. So we can say that yes, collectively they definitely have a joint control over these companies. But what is very important, now you got to see the step number 1. When you identify the concept of a common control transaction, you need to see that the group of shareholders, you need to see that the group of shareholders who have a control over the companies, the group of shareholders who have a control of the company must have a contractual agreement, must have a contractual agreement. That is very important. So what is important is that the shareholders, the group of shareholders must have a contractual agreement. If they do not have, mind the words carefully, if they do not have a contractual agreement, then common control transaction Appendix C cannot apply. So for example, now if you read further, it says shareholders B, C, D, not E, entered into a shareholders agreement in terms of governance of ABC and XYZ, due to which they exercise a joint control. Trust me, when I'm going to come to Ind AS 111 also, I'm going to say something which I'm saying right now also. It may not make much sense, but I'm going to overemphasize this when I come to Ind AS 111. And that is, if you see in this particular case, there are permutation combinations which could lead to a control of the shareholders. You can say BCD can jointly control ABC, CDE can jointly control, BDE could jointly control, or BCE could jointly control. There are a lot of permutation combinations through which, a more than 50% stake could arise. And the standard Ind AS 111 is also very clear on the picture that if more than one combinations can arise, you can say that not one combination is giving a joint control, multiple combinations are there. There has to be an agreement between the shareholders that who have decided to jointly control the entity. So the step number one is very important because, in my previous example, if you understand, there was only one shareholder who controlled. So if there is only one shareholder who controls a particular company, then I don't need to prove the concept of a contractual agreement. So I would also convert this into a three-step model. Don't worry, I'll document the three-step model, which helps you to identify a common control. So I would say, let's make this as step number two. So your step number one could be that, is there a control of one shareholder? Or is there a joint control of more than one shareholder? You need to see that the transaction is happening between the companies. So is there one shareholder who controls both the company, or is there a group of shareholders who control the company? If you say that only one shareholder controls the company, I will directly go to the step number three. I will go directly to step number three. But if you say a group of shareholders control the company, I go to the step number two and put across a question: do they have a contractual arrangement? If you say no, they do not have a contractual arrangement, I'm done. Appendix C not applicable. And if you say yes, there is a contractual agreement, as is mentioned out here, that shareholders of B, C, D enter into an agreement and they are going to exercise a control. So it is only B, C, D which have got a joint control over the two companies. So E is out of the picture. So we are saying that there are a group of shareholders. Yes. Let me go to the step number two. Is there an agreement between the group of shareholders that they're going to jointly control the entities? Yes. Now, if a transaction occurs between ABC and XYZ, if a transaction occurs between ABC and XYZ, I would say we're going to account it under Appendix C. But there is a step number three as well, which I'm not illustrating right now in this example, but I'll explain step three a little. Once you're done with step one or step number two, there is a clause which says that this common control is not transitory. It explains that the common control is not transitory. Not transitory means that it should not be artificially created, before the transaction happens. It should not be that before a transaction occurred between these two companies, we artificially try to create a common control. So we should see that it is not artificially, a creation of a common control. So what is not transitory? I'll explain, because there is a wonderful illustration in the study mat and also in the education material, which explains the step three. So let's get this picture clear. So if you remember, when I started with my first example, what I did. Now, let me just get back and let me give you a further picture. So let me just come back and give you a further picture. So I'm working on my three-step model in terms of a common control transaction. So I said in terms of step number one, step number two, and three. No worries, I'm going to make the steps very clear, but just to give you a basic idea once again. In terms of the step number one, you need to see that is there a control or is there a joint control? You need to see that is there a control or is there a joint control? Maybe there is a single shareholder who controls the companies who are going to enter into business combination. So like, for example, if I look at this case, there is Mr. X. In my example, I said there is a company AB and there is a company B. He's got an 80% stake in this company. He's also going to get 80% stake in this company. Now, if these two companies enter into a transaction, if these two companies enters into the transaction, we can say that there is a common control. Mr. X is controlling both the companies in this case. And if he's controlling both the companies in this case, any transaction between these two companies falls under Appendix C. Similarly, if I'm looking at a joint control, just see the example we did, that there are shareholders B, C, D, as well as E, and these are having a control over company ABC, XYZ. So there was a company ABC Limited and there is a company XYZ Limited. Now we saw that all these people are jointly controlling the company, but BCD has a joint control over this company and they've got a joint control over this company. So what is important is that there is a control of one shareholder between the two companies. He's got a controlling on both companies, or a group of shareholders have a control. So your step number one is just to watch out that is there one shareholder who controls the company, or is there a group of shareholders who jointly control the company? That's it. If you say that there is a control of one shareholder, you can go to step three. No need of step number two. No need of step number two. If you say that there is a joint control, you need to go to the step number two. So if there is one shareholder controlling the two companies, you can go to step three directly. And if there is group of shareholders jointly controlling the companies, you need to go to the step number two and see that is there an agreement between the two entities? Is there an agreement between the shareholders or not? Like in the illustration, it very clearly said that there is an agreement between BCD. If the agreement is there, I'll go to the step number three. And if there is no agreement, then in this case, common control aspect cannot apply. In that case, if these two companies enter into any kind of transactions, no appendix C. No appendix C. So unless these group of shareholders are entered into an agreement, the appendix C advantage cannot apply. And then you need to go to the step number three and see that this control or a joint control was not a part of some planning. We need to see that it was not a part of some planning so that companies don't unduly take advantage of book value accounting. Because the common control transaction allows you to do a pooling of interest method, a book value accounting. So the standard set is one thing very clear, that we will not allow any kind of artificial plannings. How artificial planning is done, how step number three is going to be violated, we will see that in a small little example very shortly. So this is my three-step model. So let me just come back. So let me just go back to the question number 41. A brilliant question is there in the study mat as well, but explains you in a very chronological order that, how does a common control get established? So in this particular case, as we can see in the example, A, B, C, and XYZ is owned by more than one shareholder, four shareholders who've got 25% stake in the companies. And BCD entered into a shareholders agreement in terms of governance due to which they exercise a joint control. Whether ABC, XYZ are under the common control for the purposes of appendix C. I'm adding that requirement. So I ask myself the question number one, is there one shareholder who controls the company ABC, XYZ? No. Is there more than one shareholder who controls the company ABC and XYZ? Yes. I said, okay, let's go to the step number two. Is there an agreement between these shareholders that they will jointly control these entities? I said, yes. Then I said, okay, you go to step number three and prove me that this is not a shadyantar. This is not a conspiracy. Now, how do you see that this is not a conspiracy or shadyantar? I'll explain that. In this question, I'm not given any details to apply step number three. So I presume that the control is not transitory. And I say, yes, there is a common control. So yes, a common control is there. The group is there. Agreement is there. Done. I hope, friends, I am pretty clear on the application. Don't worry. I will definitely document these things. Okay, Namrata, you said, if the appendix C does not apply, then you need to apply acquisition accounting in that case. Then acquisition accounting would apply, fair value accounting. Okay, let's have a look further on the next question number 42 with you. And this is also in the study material as well as it's in the education material as well. So you can read the detailed answer in the study. Let me just now take it further. So this is exactly the same question as 41, except that they're trying to violate the step number two. Let's read. It says in the following group structure, ABC and XYZ is owned by four shareholders, BCDE, each of who's got 25% stake, same facts. However, there is no agreements between any of the shareholders that they will exercise the power jointly. So whether there is a common control between ABC and XYZ, you know the answer very well now. So if I apply my three-step model and I go to the step number one, is there one shareholder or is there more than one shareholder who's got to join control? I said there are more than one shareholder who's got to join control. I said, okay, let's go to the step number two. Is there an agreement between the shareholders for exercising a joint control? No. Okay, then in this particular case, common control cannot apply. So now in this case, if there is any transaction between ABC and XYZ, it would be covered under acquisition accounting and the benefit of Appendix C is not applicable. I guess step 1, 2 clear. Now let's go to the third step. Let's go to the third step and see what kind of plannings the companies could enter into. So this is one of the questions which is given in the education material. It's there in the study material as well. And it illustrates how companies could do conspiracy and they try to take advantage of a common control transactions as well. Let's have a look. It says ABC has got a subsidiary, namely X. So ABC has got a control over X. Then he says which acquired on 1st April 2000. ABC acquires all the shares of Y on 1st April 17. So you can say that ABC controls X and ABC also controls Y, though we can see that ABC company had a control over the company X that was way back on 1st April 2000. And the company ABC has got a recent control and on Y on 1st April 17. So apparently, if there is any transaction between X and Y. So let me, I think, just read the question till this stage and do the analysis. In this particular case, let me put across a question to myself. Is there a single shareholder or multiple shareholders who have a joint control over the companies X and Y? I would say that there is a single shareholder. ABC company has a control. So we can say there is a single shareholder who's got a control over X and Y. So step number 2 is not required because there is only one shareholder who has got a control over both the company. So we just need to see that step number 3. But if I don't look at the step number 3 and I just see that are they under the common control between ABC? Yes. So if there is any transaction between X and Y, then a common control Appendix C should apply. But conspiracy. It says ABC transfers the shares in Y to X. ABC is transferring the shares to Y to X on 2nd April. 1st April Fool's Day, he acquires the shares in Y, and 2nd April, he finishes the Fool's Day to the person. He transfers the shares to Y. So what happens? That the transaction looks like this, that ABC has got a control over X and he passes on the control to Y. So in this particular case, it says that ABC transfers the shares in Y to X on 2nd April 17. Should the above transfer be accounted for the consolidated financial statements of X? Now you need to see the picture in between. You need to understand that ABC acquired Y so that he could bring it under the control. And then it was passed on to X so that a transaction when happens between X and Y is proven that it is under the common control. But just imagine if ABC would not have acquired a control over Y and we would have told X to directly acquire the shares in Y then. Can I say in that particular case, this part of the chain would have been missing? If X would have gone and directly taken an acquisition of Y, was Y under the control of ABC? No. In this particular case, we would have said that before a transaction occurred between X and Y, both X and Y were never under the control of ABC. It is only one day, it remembers me that movie which came, where we said Prime Minister for a day. You're asked to make a prime minister for a day. So this is what is happening in this case as well. That one day you establish a control so that the second day when a transaction occurs, and I put myself a question, was X under the control of ABC before? Yes. Was Y under the control of ABC before? Yes. Is X and Y going to be under the control of ABC after? Yes, because it is subsidiary. So I would say X and Y before the combinations were under the control of ABC, XY after the business combination still under the control of ABC, but this was possible only because you established a control for 1 day over Y. If this transaction would not have occurred, then Y was never under the control of ABC, and therefore Appendix C advantage cannot be taken with X and Y. Therefore, the standard setters decided that रिश्ता नहीं तो Appendix C नहीं. रिश्ता होगा तो Appendix C लगेगा, which means Appendix C is going to be triggering only when there is a common control, and that common control is not something which is established a few days or months earlier. Now you would say, so what is the cutoff date? When do you say that, if ABC got a control over Y, how much leverage are you going to give to them and tell them, well, nothing is given in the standard, it is open to judgment. You need to see that is this planning of bringing Y under the control of ABC was a part of the conspiracy or not. You'll have to look at the facts and circumstances, but all I can say that in this case, it is a clear-cut case, just a 1 day gap. But there is no cutoffs. If you ask me, how do you make an assessment? You'll have to look at the facts of the case and decide. Right, friends. So I think so far so good. I guess I am clear. You can still see a little diagram as well to see the positions clear. So this is what has been done on an intermediate basis to give you a clarity of thought. So what the company actually did, they artificially created this intermediate situation. Because ABC had a control over X. Artificially, you created a control over Y, and then you did this particular transaction. So this is something, if it would not have taken place, if I would have done the transaction directly, X acquired Y without ABC acquiring Y, it would never pass the parameters of a common control. Right? I hope I've made myself pretty clear. Now we can understand the accounting treatment further. Clear? Wonderful. Okay, so let's, I think, document the 3-step model to you in terms of the common control transactions. Then we'll get on to the accounting part of it. So let me just add the notes now, the 3-step model. So I've created my 3-step model, which helps me to trigger. This is not a 3-step model given in the standard. I've created it for the ease of understanding. So let's, I think, give you the concept in terms of common control transactions. So we're looking at the aspect of common control that is addressed by Appendix C of the Ind AS. So we've got a 3-step model in terms of identifying the common control. So let's apply the 3-step model. And then you can, as a part of the 3-step model, revise these 3 questions, 41, 42, 43 in a row, and you will be able to get this. So for this, I would say just revise the question number 41 to 43, which I gave you in the assignment, which will help you to identify the control. Now, in terms of the step number 1, we need to see that does a single shareholder have a control? Does a single shareholder have a control? Or, so does a single shareholder have a control, or more than one shareholder? Or more than one shareholder has a joint control. So we need to see that does a single shareholder have a control, or more than one shareholder has a joint control. I'm putting it as GC. So that's the very first question I need to put across to myself. So there will be 2 permutation combinations. So I would say that there is a control by 1. I would say there is a control by 1, or I would say there is a joint control by more than 1. So you need to see, is it a case of control by 1 or a joint control which is more than 1? So when you say it's a control by 1, you go to step number 3 directly. And if it is a case of joint control by more than 1, then you need to go to the step number 2, first of all, to get the focus clear. Then we go to the step number 2, only in case there is a joint control more than 1, and we see that is there an agreement Is there an agreement, underline the word agreement, between the shareholders? So is there an agreement between the shareholders to exercise joint control? To exercise the joint control. So you need to see that there is an agreement to exercise the joint control. So the answer would be a yes or a no. So if you say that there is no agreement, then we can say Appendix C not applicable. In this case, Appendix C is not applicable. So what would apply? So we will apply acquisition accounting. In that case, we will apply acquisition accounting. You'll have to do a fair value accounting. And if you say yes, in that case, we go to step number 3. We go to the step number 3 in that particular case. Okay. And then finally, when I'm looking in terms of the step number 3, so in terms of the step number 3, we need to see that this control or joint control is not transitory. So you need to prove that it is not transitory. So transitory means it's not created on a temporary basis. So we need to prove. So we need to basically prove that the control or the joint control is not transitory. So if we say, yes, it is not transitory, then Appendix C applies. Then Appendix C applies. So if you say, yes, it is not, Appendix C applies. If you say, no, the control is transitory in nature, then we can say Appendix C not applicable. So what is going to apply again? The acquisition accounting would apply. So in this particular case, we'd apply the concept of acquisition accounting. Wow. So I hope I made myself very clear on the understanding when a common control transactions would occur with a 3-step model. That is a single shareholder having a control or more than one having a joint control. If it is single, we can see in question 43 that there was a planning and it was conspiracy. So we said, no, it's transitory, boss cannot apply. And if there is more than one shareholders, we've seen questions that you need to see in step 2 that they have an agreement. If there is no agreement, Appendix C not applicable. And then of course you come back to the step number 3 as well. Okay. Right. So far, so good. I guess now let's take it further. Let's, I think, now take you to the inputs in terms of the accounting. So what kind of accounting is being suggested in terms of a common control? So let's take a basic understanding to begin with. Now, if I'm looking at the accounting treatment, when the Appendix C would trigger, the accounting treatment is simple because it allows you the concept of pooling of interest method. It allows you the concept of what we call the pooling of interest method. And this is based on what we say book value accounting. No fair value accounting is going to be purely a book value accounting. Now, let's go back to the same example where I said there was a company AB and it demerged a company B, giving the shares to Mr. X. So let's consider that example that there is an existing company. Let's consider there is an existing company. And let's consider that there is a new company in the same example which we did. The existing company is company AB Limited. And the new company which I gave you was B Limited. So I'm taking that example as a base to explain the accounting, typically what happens in a demerger, because most of the questions which you are given in terms of common control transactions are concentrated in terms of demerger, that there is a single shareholder and he had a control before and after the business combinations on both the companies transacting with each other. So typically I am taking that demerger as a base to explain the accounting in the books of the existing company and the new company as well. Now, what is the existing company going to do is pretty simple. What it needs to do, it needs to basically close the liabilities which are taken over at a book value, debit the liabilities. The objective is basically to close those assets and liabilities which have been taken over. So debit the liabilities which have been transferred to B and credit the assets which have been transferred to A. So they will transfer to B. These are at a book value. That's it. Did he get anything in return? No. The consideration is given to the shareholders of AB and not to AB. So that's it. So what I'm going to do in this case, close the assets and liability, and any balancing figure in this entry is what you can say is a loss which is arising. Generally, it would be a loss. It can be gain or loss, whatever. So the balancing figure is going to be directly put in terms of other equity. It is going to be put directly in terms of other equity itself. So whatever is the gain or the loss, I'll just put it directly to other equity. That is what we call SOCI. Statement of changes in equity. So we're going to put this amount directly in terms of other equity. That's it. So you, in the entry, you get other equity as a debit or credit, whatever the case might be. No goodwill, no capital reserves. Okay. Now, in terms of the new company, what is the accounting this company is going to do? They will record the assets, and these assets will be incorporated at a book value. So since a book value accounting is applied, they're going to record things at book value. Now, something very interesting. When a common control transaction triggers, the new company cannot record any new asset in the books. He would land up recording only those assets and liability which have been transferred to this company. So as a part of the assets and liabilities in the entry, there are two focus points to be considered. So there are two focus points to be considered. So let me give you the focus points out here. So when a book value accounting is applied, so basically what we're doing, we are just demerging things. So in this particular case, or maybe we're just merging things. Remember the question we did a little while back on reverse acquisition, AB and BX merging into ABX, that was merger. So what are you going to do? You're just going to pool the interest at the two balance sheets, get the answer. So you can see two kinds of questions are given. If it is a case of a merger, AB and BX merge. So what do you do? Just add the two balance sheets to get the answer. Trust me. Go back to the same question which we did in the morning, where they said that AB and BX are under the common control. If AB and BX are under the common control, you've got a balance sheet of AB and BX. Just add the balance sheet line by line. Everything just added line by line. You get the resultant balance sheet in itself. That's merger. That's pooling of interest, related party transaction. And this is, I'm doing demerger. So you're going to see basically two kinds of questions on Appendix C, which are addressed in the study material as well. One is a case of merger, which is pretty simple. Two entities merge, just add the balance sheets, get the answer. So I'm not doing a question on that. And then there is a case of a demerger. So I'm giving you entries on a demerger, and I'll do a question on a demerger as well. So the two focus points to be kept in mind is that no fair value concept would apply. You're not going to record anything at a fair value, just at a book value. And secondly, in this particular case, no new asset or liability can be taken. You cannot insert in this entry any asset or liability which was not present in the balance sheet of the acquiree. So that cannot appear. And then you're going to take the purchase consideration. Now there is some interesting points on the PC as well. Now, when you go to consider the concept of a purchase consideration in this particular case, there is another focus point on the PC. So the focus point in terms of the purchase consideration is your purchase consideration will be sum total of a cash, and you will take the face value. You heard me correct. You will take the face value of equity shares. No premium is to be considered. No premium is to be considered. So when you are going to record the shares issued against the purchase consideration, the standard makes it very clear that you need to consider only the face value of the equity shares as a part of PC. So you'll never land up considering any share premium in terms, security premium in terms of the consideration. And then again, there will be a balancing figure in this entry. The balancing figure in this case, just like the books of the existing company, is going to be transferred to the other equity, that is SOCI. So we're going to put this difference directly in terms of SOCI, that is other equity. Simple and straight accounting. Let me also tell you something very interesting. that the International Accounting Standard Board believes and is still working on the area of bringing out a separate standard on a common control transaction. Right now, this Appendix C is not a part of IFRS 3. This Appendix C, what you're studying right now, is not a part of the IFRS 3. The corresponding standard in IFRS is IFRS 3 against Ind AS 103. And this appendix is just one of the IFRIC. I don't remember what is the IFRIC number, but it's just an IFRIC. But the standard IASB, the International Accounting Standard Board, is actually working to address these kind of complicated transactions to identify a related party or not. They're going to create a separate standard on this. And the new changes coming in terms of IFRS and Ind AS is the climatic parameters are being incorporated in the accounting world. So that means in the coming future, in the next 5, 7, 10 years or whatever, maybe 5 years at the max, or 3 to 5 years, I would say, you are going to see a lot of changes in accounting coming in, because these standards would also incorporate the climatic effects, because we know that there is a sustainability board. And it is also introducing, standards relating to climatic effects. So you're going to see that, we're going to give the bad treatment to companies which, spoil climates. We're going to give a good treatment to companies which do not spoil climates. So the accounting world is also taking cognizance of the fact that you're good or you're bad. You earn at the cost of the society, or you earn by doing something good to the society. Good accounting for the good people, bad accounting for the bad people. I like it. Okay, so this is done. Let's now take you to a practical illustration. Let's see the application in terms of a question. So I'm going to now take you to a practical illustration on the common control transaction. This is a question which is given in the study mat itself. And let's, I think, read the question to you. Question number 44 in the assignment. It's there in the study material also. You can see an illustration on the study mat on this. So let me just read the question to you and we're going to solve. Let me see in between any questions coming so far or not. Okay, I think everything is good to go. Okay, so let's take the journey forward. It's a complicated standard, but a beautiful standard as well. Now, let's have a read on question number 44. It says Maximini has got 2 divisions. So Maximini has got 2 divisions, Maxi and Mini, quite similar to the example I gave. So there is an existing company, Maximini, which has got 2 divisions, and the balance sheet on 31st October X2 is given. So we are given the status of the assets and liabilities of the company division separately, though you can see that there is a common share capital and common equity. So as far as the other equity and the share capital is concerned, it's common to the company, but the segregation of the division assets and liabilities are given. It is decided to form a new company, Mini, to take over the assets and liabilities of Mini division. So we can clearly see that it is a case of demerger. So whether it's a merger between related parties or it's a demerger between related parties, the Appendix C applies. Accordingly, Mini is incorporated to take over at balance sheet figures, book value, the assets and liabilities of that division. Mini will allot 5 crore equity shares of 10 each in the company to the members of Maximini. And if you recall, I said very clearly that in a demerger, the shares should not go to Maximini. The shares should go to the shareholders of Maximini. Otherwise, the new company would become a subsidiary of Maximini. The members of Maximini are therefore to become the members of Mini as well without having to make any further investments. You're required to pass journal entries in relation to the above in the books of Maximini and in the books of Mini. Also show the balance sheets of the 2 companies on the morning of 1st November. It says make a balance sheet on the morning of 1st November. So people might think that what is this morning of 1st November? Well, that was just to create a little emotions. This is also a question which came, I think, if I rightly remember, in the year November 2020 in CA Final Old Course. If you go back to the CA Final Old Course way back in 2020, I'm like taking it 23 years back. So 23 years back, the same question came in CA Final Old Course. Can you imagine? At the time, this question you can see in the study now based on Ind AS. Showing the corresponding previous year figures, the directors of the two company ask you to find out the net asset value of equity shares, that is pre and post demerger, and comment upon the impact of demerger on the shareholders' wealth. Well, just for your knowledge, let me tell you that the concept of demerger was something, which came to India and was very prominently understood by the industry, especially in terms of Reliance industry. So Reliance Industry, when the senior Mr. Ambani had to split his company between the two children, that is where the concept of demerger came in. One of the very renowned lawyers, I may not recall the name, and he actually carried out the scheme of demerger for that company. And that's how, we came to know that there is something called a demerger. When Reliance Industry did this, I guess there are a couple of concepts, which have been attributed to their things, like the concept of a MAT provisions, the concept of a demerger. So I would say thanks to the, the kind of transactions that we get these complex transactions to study in India as well. Okay. So having now understood the question, let's get on to the solution. So I am now going to look at the entries in the books of Maximini and in the books of Mini. So let's begin with the books of Maximini. So let's have a look at the books of Maximini, which is the existing company where the objective is only to close the books of accounts. So let's have a look at this. Just keep the balance sheet in front of you. And in this particular case, let me just a second. Let me just open up the question. Yes. So now let's just keep the balance sheet in front of us, and we need to close the mini division. So just look at the assets and liability in mini division. So you've got a property, plant, equipment. So let's do one thing. Let's credit the PPE at cost, and let's debit the accumulated depreciation separately. So basically I'm closing the assets and liability. So accumulated depreciation is 100 and the asset is 300. Then we've got current assets that is to be closed, that is 300 again. And we're given the current liabilities, that is 100. So we debit the current liabilities, and that is to the extent of 100. So the assets and liabilities are done. Then there is also a loan. So we'll also give a closure to the loan, that is 100. So basically what we've done is I have debited all the liabilities, given a credit to all the assets, and taking a closure. So now what I need to do in this particular case, get the balancing figure. Let's see what is the balancing figure in this entry. This is a liability which have been transferred to Mini. Let's now go to the books of Mini. So let's have a look at the entries in the books of Mini. So in the books of Mini now, we are looking at this new company, and in terms of the new company, we now know the rules. Assets and liabilities taken at a book value, PC shares taken at a face value. So let's record the things out here. PPE gets a debit. That's going to be 200. So PPE gets a debit at a book value. Then current assets gets a debit to the extent of the book value, 300. And then current liabilities and loans gets a credit. The current liabilities are 100 and the loan is also 100. So incorporated the assets and liabilities all at a book value. And now let's see the purchase consideration. So very clearly we are given Mini is going to allot 5 crore shares of 10 each. So they are going to record the equity share capital as a part of the PC. So this is 5 crore shares of 10 rupees, and that works out at 50. So any balancing figure is going to be a gain or loss adjusted against in terms of other equity. So let's see what is the balancing figure. So this is, I guess, 500 and this is 250. So we are getting a balancing figure on the credit side, that is other equity. And let me, I think, show you some other good analysis as well. So once you do this question, especially on a demerger, you can see some wonderful analysis coming in. Can you see his loss is 300 And the sum total of the equity share capital and other equity is also 300. Wow. I always look at this and it reminds me a phrase, one man meats is another man's poison. How true it is in terms of a demerger accounting. Tera nuksan mera faida, mera nuksan tera faida. So you can see that one man's meat is supposed to be another man's poison. At the loss, he is getting a gain. So basically what you're doing in a demerger, the wealth accumulated by the main company, like if you look at Reliance Industry, is getting distributed between the children. So you are basically going to retain this company. A part of the reserves of this company is being taken out and pushed to the other company. So one son carries out the company, after the demerger, this and the other. So demerger could result in, let's say if a common shareholding is there, so both the sons own this company, then maybe they can transact later, whatever. I mean, I'm not getting into those nitty-gritty. But basically, you can say a wealth portion of this company is getting transferred to the other company. So you're going to notice the sum total of the consideration coupled with the other equity, the gain, is going to be the loss as compared to the existing company. Now, let's make the balance sheet in this case. So he was asking us, number one, to take journal entries and then make balance sheets. And then I want to make net asset value per share calculations and give comments on well. So let's do one thing. Let's make some balance sheets to you. So I'm going to make a balance sheet of Maxi Mini and Mini as well. So I want to see this pre and post demerger. So let's make the balance sheet of Maxi Mini and let's look at the balance sheet of Mini. So we want to see this pre-demerger and post-demerger. And this, of course, is post-demerger. So pre-merger, you can just, take it from the question itself directly. So let me just copy the balance sheet given in the question as it is. So I'm taking the assets PPE, just a rough balance sheet I'm making, not giving very appropriate headings. So we've got this as 300. Then there is a current assets that is 700. And I guess that's it on the asset side. So let me just close the balance sheet at this stage. So this is on the asset side of the balance sheet. So let's have a look now on the liability side. We've got equity capital is 50. So there is equity share capital that is 50. There is other equity. And the other equity is to the extent of, let me create a little more space. So there is other equity that is 650. Then there is loan. The loan is appearing in the balance sheet at 100 and the current liabilities are appearing at 200. So this is the existing balance sheet I've taken from the question itself. So this is 1000 and this is also 1000. So this is the existing balance sheet of Maxi Mini picked up from the question directly. Now what do you need to do? Incorporate the entries which I did and make the new balance sheet. So I think for Maxi Mini, let me just keep eliminating the mini division. So 200 of the assets is gone. 200 is gone out here. And out of the current assets, we can see that 300 is gone. So 400 is left over. So this is the 300 gone to mini. So I'm just pushing that mini division to mini limited. And then I am given on the loans, this entire loan is gone out here. And on the current liabilities, we have pushed in 100 is left here and the rest 100 is gone here. That is how the split has happened. So the balance sheet asset side is done. So this equity share capital continues to be the same. Out of the 650, he got a huge loss of 300. That is in the entry, you got a loss of 300. So that makes it 350. And here again, he issued equity shares worth 50, basically 1:1. And he got a huge gain in the other equity, that's 250. So this is 500. And this is also 500. So this is the balance sheet of Maxi Mini and Mini, that is pre as well as a post demerger. So one requirement of the question is done, journal entries and the balance sheets of the company pre and post demerger is done. Now, the next focus. The next focus is, it says, I want the net asset value. I need the value of the share, net asset value per share. So we need to calculate what is the net asset value per share for these companies, because the requirement is also to give an impact on the demerger wealth. So we will be able to give an impact on the demerger's wealth once we know that what is the intrinsic value, or you can say the net asset value per share. So we've got Maxi Mini and we've got the company Mini. So let us see what is the value pre and post demerger. And here also, let's see the value which is post demerger. Let's get the intrinsic value or the net asset value per share. So for this purpose, when you're looking at the intrinsic value, you just need the net assets divided by the number of shares, and you're going to get the value per share. So you will just take the net assets and divide it by the number of shares to get the value per share. Now, in terms of the net assets, you can take equity plus equity share capital. Either you take assets minus liability, or just take the sum total of the equity share capital plus the other equity. So either assets minus liability, or just take share capital plus other equity. So that works out at 700 earlier. Then it became 400 and this became 300. And you can see, wow, 700 got split between 400 and 300. Now, number of shares earlier and now everything is 5 crores. So this comes to 140, this is 80, and this is 60. Now, I think the game is simple. The company gave 1 share for every 1 share to every shareholder. There were a total of 5 crore shares in Maxi Mini, and every shareholder is given 5 crore shares in Mini. So they get an ownership which is 1:1. So you can see earlier, if you look at the position earlier, a shareholder had 1 share in this company. So his wealth was 140. Now he's got 1 share which is worth 80, and he's got 1 share which is worth 60. His wealth still remains at 140. So even after the demerger, the company ensured that since a book value accounting was applied, the shareholders' wealth is totally unaffected. The shareholders had 1 share earlier in company Maxi Mini. Now they've got 1 share in each of these companies, but his wealth position is intact. And is this something which is bound to be in terms of a common control demerger? Yes. So there is no impact in terms of the shareholders' wealth. The shareholders have got the same wealth as they had earlier before this transaction occurred. Wow. So all the requirements of the question stands answered, and the Appendix B, the common control aspects, is also taken care of, friends. So I have now finished completely in terms of Ind AS 103 with you. So we've spent almost like 5 classes on this. My next class, of course, is going to be on consolidations. We'll be starting with the concept of Ind AS 111, then followed by, Ind AS 110, followed by Ind AS 111, and then Ind AS 28, and a little inputs in terms of Ind AS 27. And that would cover up the entire focus in terms of consolidation standards. Our journey started on Ind AS 103. But my sincere request, friends, now is that you must sit down and do your revisions on a consolidated manner. Since, when you're studying a particular Ind AS for the first time with such a complexities, it's very difficult, when you're doing it in bits and parts. But having understood the things now, you should sit down and make a complete consolidated revision of all these 5 classes. The classes, of course, are there on the YouTube to watch any number of times, n number of times. I know what the people do as well. You must do that. I think it's not harmful at all. Since you've all done that, you want to run it again at a 2x speed on your own, you can do that. I know in live classes, you can't run the person faster than what he is. but I think my pace is also good enough where listening to me on a 2x could be an agenda. But anyway, I think you can still love the idea of moving me on a 2x or a 1.5x speed, at a later stage. Do your revisions, do this complete standard in one go. Trust me, you're going to get a good control over this particular standard. Let me see if any further questions coming so far on this, friends. Any questions on your side, friends? Let me know. But otherwise, now we are done with the standard with a few more inputs, which you will see in the study mat here and there. But the larger picture is being completely done. Your acquisition accounting with a 7-step model, your reverse acquisition where a new entity is created or not, the common control transactions in terms of a demerger as well as a merger. That question AB and BX is a merger where you just add the balance sheet. So 2 varieties we have done on reverse acquisition, 2 varieties we have done on common control, and we have covered the entire 7 steps on acquisition accounting. Okay, so far so good. I guess no further questions coming in so far. So time to bid you goodbye, friends, on that. I'll join you back on Thursday. So till then, thank you, take care, and goodbye.